Okay, we're back and we're going to talk about contracts and grants transactions. These are typically, as you may recall, they're typically from our government, either the federal government or through the state, local governments, often funded by dollars from the U.S. government. So typically these are coming from the U.S. government, and there are occasions when it comes from others. When these come through, they are, generally speaking, for the following types of deals. One would be a specific purpose, build a building, or clear a park. And here's what it's going to cost you, here's what we anticipate, here's what you budgeted for us, and so we're given the money for this specific purpose. Other times it's for performing services for a period of time, like our clinic, our client, the clinic, the health clinic. It's a year-by-year contract. Every year we tell them what we think it's going to cost. We give them a budget. The grant will be based on the budgeted amount with approved cost, approved budget, and that's how much the grant award will be in order to run the clinic for the year. If we don't do a good job, our contract will be canceled, like that. If we do a good job, then we'll be around for the next year to get another approved grant for the year after that. In any case, and these grants for either purpose are usually related to our skills and our mission. And that's how these things get started. So let's take an example. We're awarded by the Department of Labor for a $100,000 contract for whatever reason. Yay, yay, yay. All right, how did we get the award? We applied for it. We gave them the reasons why they should use our organization. And after the government took a good look at it and compared it to other proposals by other organizations, we were awarded the $100,000 contract. At this point in time, we don't record anything. It's true, we've been awarded the contract, but we're not entitled to anything unless we perform. So this is not much different than a conditional pledge. The condition is we perform, and we better perform it right. When we do perform, then we're going to be entitled to money. So as we go along, sort of like a timeline, as time goes on, as we spend dollars, then we'll be entitled to the dollars we spend on the contract, subject to the terms of the contract, which we'll get an idea of what they can be like momentarily. Let's take this example maybe a slightly more deeper, not much more, but just a little bit to get an idea. Oftentimes, these contracts are awarded and we want to get started, so we'll go out and we'll contract with people who will be involved in helping us fulfill the contract. Let's say it's, again, the mental health clinic, so we might have to get a physician or a social worker on board, and they might ask for an upfront retainer in order to entice them to sign the contract and deal with us. This retainer or upfront cost is really a prepaid expense. It would be a prepaid expense even in a for-profit entity because you're just paying upfront for services to be rendered. And so we're going to go like this, $5K. Simple transaction. All right, let's go to the next step. Let's just keep this transaction in mind as part of our looks into the future here to see how this works. Most nonprofit organizations don't have the kind of cash to pay for the entire grant without receiving any of the grant money, so they can't wait until the end of the grant to receive the money. They normally need to get some money as the funds are expended throughout the course of the grant for whatever reason, whether it's for the project or for services to be performed over a year, either way. And it's not unusual to have the government grant give a down payment or a prepayment in order to get started. So my mental health clinic on July 1 will receive a check. In their case, they receive a check for 40% of the annual expenditures, which is a fairly decent amount to get started with. So they all start off with lots of cash, and they feel real rich. But the next payment's not going to be until 6 or 7 months later. So they're going to get out of pocket a little bit. They'll spend this up pretty quickly, before they're entitled to the next installment. At any rate, we're going to get a 20% payment, so let's see what that means in terms of journal entries. Basically means the following: cash, obviously, $20K, and in our case, it's really paying us back for the prepaid expense, the $5K. So that is now out the window, and we've got the $15K. Well, what do you think where that would go? Let's let you think about that. How might you accrue, or, oh, there's that word, accrue. How might you accrue that, or why is it accrued? Well, it's an accrued expense because what's the grant money for? The grant money is for what we're supposed to spend it on: the grant, the project, the services that we're supposed to render. So we've now received an upfront amount of the amount that we're supposed to spend. We haven't spent it yet, so this is a liability. So we're going to call it an accrued expense, but any kind of liability title you come up with would work. One more thing we'll do at this point is we will show the fact that the prepaid expense has been incurred. We're now going to show that as an expense to finish the entry, and we'll record it as being for the grant revenue. This way the expenditures match the grant revenue. That's part of the key of the matching principle here in the nonprofit world, is we're going to match the grant revenue with the expenses as they're incurred. These two could have been put differently. We could have done it the opposite way, meaning that we could have recorded the grant revenue at this point instead of a credit to the prepaid, and put the prepaid in this entry here. Either way, it's the same. It amounts to the same thing. It just depends on the timing of when the prepaid got used up. So to say it in other words, let's do it again, which would be good practice. Let's do the whole thing again, which would be good practice. We receive the cash of the 20 grand. We could put 5 of it to grant revenue received, and that works. Well, let's just call it grant revenue, because we already incurred $5,000 with the prepaid item, meaning we already laid it out, so we were already entitled to get $5,000 from the government, because we had, although it's a prepaid, we had spent it, so now we're entitled to get grant revenue from the government. Then we'll put the other $15K to the accrued expenses that we mentioned. You could also, that's the best way to call it, accrued expenses, because we're supposed to spend the money, the $15K, that's what it's given to us for, to incur expense towards the project. It's a liability. If we don't spend it, we're going to have to give it back to the government. Then, when the prepaid has been used up, meaning the consultant that we hired and gave a down payment for, a retainer for, they billed us for at least this much, it'll be expended towards the project, or whatever type of expense it should go to. All right, hopefully you're getting the idea. Now, what's next? What's next is that we start spending money. We have $15K available, and we start spending that down, and then we start spending other money or incurring other expenses by getting invoiced for expenses beyond the 15. We spend the 15. We incur expenses for when the amount goes above the 15,000, and we start building up. Basically, we start building up monies that we should get from the grant. Sometimes we actually spend the money. Sometimes we just get the invoice and we hold on to it. whatever the case may be, what the organization will do is bundle up expenses that have been incurred. They'll submit it to the contracting agency, the government agency, the funder, that gave the grant or the contract. They'll bundle it up and they'll say, here are the dollars that we've expensed. Please approve these. That they are appropriate and proper within the grant that you gave us the grant for, that they are the right amounts in the right categories, and once approved, then the money will be sent by the government to us to pay the bills, to pay these bills. And this will occur throughout the contract based on the terms of the contract. It could happen every quarter, every 2 months, every 4 months. It all depends on the contract terms. So the money would come in as cash. Now, when that happens, there's a couple things that are going on. First of all, when we spend, remember that 15 that we had, the accrued expenses, when we spend that, we're going to debit accrued expenses. Obviously, we're going to credit cash because we'll have used it up. And then what we'll do is the following. Since we've incurred the expense at this point, we will show the expense in the category that it belongs. Well, I know the amount. Why did I do that? I know it's 15 grand. So we'll do 15 grand to the expenses. And now we'll record grant revenue. Why? Because that's why we received it. It's grant revenue. And you see what's happening is that we're actually, again, continuing to match the expenses to the grant revenue. In other words, up till now, we've shown the cash come in, but we didn't show where the source of the cash was. Once we spend it, according to the way we're supposed to spend it by the contract, it is now grant revenue because it now belongs to us, because it's like a conditional, very similar to a conditional pledge. We've met the condition. The condition is spend it appropriately according to the terms. Once we spend it, the conditions have been met, and now we can record the revenue. So we'll say it this way. Meet conditions. That's not the right word. There we go. Meet the conditions, record the revenue. So the same thing will happen going forward. We'll incur expenses, and when we incur the expenses, we'll put them to accounts payable because we owe it. And at the same time, let's say it's $25,000. This is after the 15, so we incur accounts payable of 25. We don't pay them yet. Let's say we didn't have the money, so we don't pay them. And now what we'll do at the same time is we'll record a grant receivable. And at the same time we do this, and we'll record the grant revenue for the 25 in this case, because we've spent it, we've met the condition. The condition is spend it, that was met, so now we can record the revenue. And then when we submit these, let's say we bundle this group up, we bundle it up, submit it to the government says, okay, you've done right, and they send us to 25. Okay, well, you know what happens then. We will do the following. We will record the cash coming in, 25. We'll credit the receivable, the grant receivable, so that's off the books. Now what do you think happens? We use the cash to do what? To pay off the people we owe the money for. These are typical transactions in this kind of deal. And we'll, 25, it should be 25, right? Yep, 25. One more time. There we go. And we'll pick this up next time and continue on.